gentlemen, good day and welcome to GREAVESCOT Limited Q2 and H1 FY26 earnings conference call. We have with us today Mr. Parag Satpute as Managing Director and Group CEO, Ms. Akhila Balchandra, CFO GCL, and Mr. Vikas Singh, Managing Director GEML. We would like to begin the call with brief opening remarks from the management, following which we will have the forum open for an interactive question and answer session. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation shared with you earlier. Further, as you are aware, Greaves Electric Mobility Limited has filed a draft red herring prospectus with the capital markets regulator, SEBI, to raise funds to an IPO. All discussions in this call with regards to this entity may be read in conjunction with and be limited to the said DRHP. I now hand the conference over to Mr. Parag Satpute. Thank you, and over to you, Mr. Satpute.
Thank you. Good morning, ladies and gentlemen. Thanks for joining us today. Let me tell you how we are going to conduct this session. I will start off giving you an update on our business for the last quarter for the GREAVESCOT Limited's core businesses. I will then hand over to Mr. Vikas Singh, who will take you through the performance of Greaves Electric. Akhila will follow that with a financial roundup of the business. And then I am going to come on again to talk about our new strategy, something which we had promised to tell you during our last investor calls. So let me start with this quarter. The quarter marked another phase of steady progress for us. We executed well, strengthened our portfolio, and continued to invest in future-ready technologies. Even in a dynamic environment, our businesses sustained momentum backed by operational excellence and disciplined capital management. Now, as we move into the second half, the outlook stays positive across most of our lines of business. For the automotive and genset, demand remains healthy, helped by infrastructure spending, rising urban activity, and industrial recovery. Also, agriculture and construction are improving with a good monsoon, while mining and urban infrastructure stays strong. Of course, in the management, we are keeping an eye on the pace of projects, on rural sentiment, and the interest rate trends. But our diversified portfolio gives us resilience to manage this shift confidently. Let me talk about the segments one by one now. In the automotive engine segment, the demand for the three-wheelers and small commercial vehicles continued to revive, which is supported by stable fuel prices and better fleet utilization. The move towards cleaner fuels, which is CNG, LPG, and electric, is gradual, and it is fully aligned with our strategy of building a fuel-agnostic powertrain portfolio, which serves not just today's mobility but also tomorrow's. Our genset business is also strengthening, and our market share is now around 4%, thanks to very reliable products and a widening customer reach. Our industrial engines, both the single and multi-cylinder platforms, continue to power diverse applications such as construction, agriculture, firefighting, marine, and industrial. Moving to Excel, we had a stable quarter there. Within that portfolio, the domestic business, built on strong partnerships with OEMs, grew quite well. New orders came in from automotive, construction equipment, and marine OEMs. Also, the key CapEx projects which we have started were completed on schedule and are now ready to generate new business. Excel is also increasing efforts to expand globally, especially to balance the dependence we have had on a concentrated geography. What is heartening is margins remain healthy at roughly 27%. Overall, for GCL, exports continues the strong run. It is led by the Euro 5 Plus automotive engines, our collaboration with a company called Ligier, which is a leading European microcar OEM, has developed very well, and it showcases Greaves' engineering ability and quality of our products. I'm happy to say that exports now forms a double-digit share of our revenues across GCL and Excel, and the new discussions we have ongoing with global OEMs are expected to translate into more long-term, high-margin programs. Coming to technology, we are also investing in advanced technologies, such as multi-fuel gensets and rare earth-free motors. Our partnership with Chara Technologies to enhance sustainability and cost efficiency is developing quite well. Within the retail and aftermarket, while the diesel three-wheeler spares saw some short-term softness, our focus stayed on expanding the network and strengthening our channels to deepen our customer engagement. Within retail, the institutional sales, particularly to railways, grew strongly year on year. Financially, GREAVESCOT remains net cash positive. We continue to invest in capacity expansion, in modernization, and new product development, which ensures readiness for the next cycle of growth. Our R&D engine is also running strong. It is focused on fuel-agnostic products, EV powertrain components, and hybrid systems. Demand for our Euro 5 Plus single-cylinder engine for microcars remains robust. Our CPC V4 Plus genset range is fully rolled out and is seeing a very encouraging response. And finally, the integration of Excel's precision engineering is helping us to speed up validation and improve time to market. And this is an advantage for us as we scale. I'm now going to hand over to Vikas to talk about the Greaves Electric business. Over to you, Vikas.
Thank you, Parag. Good morning, ladies and gentlemen. Thank you for joining us today on our earnings call. I will provide a brief overview of Greaves Electric Mobility performance and recent exciting developments before we open the floor for your questions. I'm pleased to share an update on our performance for the second quarter and first half of the year 26. The last 6 months have been a period of steady progress for Greaves Electric Mobility, reflecting our continued focus on execution, efficiency, and further strengthening and enhancing our customer trust. In the electric two-wheeler segment, Vahan volumes grew by 54% year-on-year in H126, led by product enhancement and network expansion. Our market share continued to improve from 3.2% last 4.2% this year, with the following regional positions: 12% share in Tamil Nadu, which is a very big market, 14% share in Bihar, and 6% share in Orissa during quarter 2. The Ampere Nexus and Magnus Grand have played a key role in driving this growth. The Magnus Grand launched this quarter at a price point of about 90,000 rupees. The next generation electric family scooter featuring a durable LFP battery, 5-year 75,000 warranty included, and advanced new brake technology, new digital cluster, and premium dual-tone colors with gold badging. This has been a clear success for us and has helped us build our share and our position in this very sensitive and large segment. Meanwhile, the Ampere Nexus, which has been recognized by the India Book of Records for being the first electric scooter to reach 13,200 feet at the Shipkila Pass, now comes with smart connectivity features such as map mirroring, music/call alerts, and performance insights, thereby enhancing the overall rider experience. On the three-wheeler L5 front, the business has maintained steady momentum, with L5 Vahan volumes up 9% year-on-year. Our L City Extra, the EV solution in L5, has been recognized by the India Book of Records for a 324-kilometer journey on a single charge range and offering IoT features. These achievements highlight our commitment to innovation, sustainability, and inclusive electric mobility, driving India's shift towards a cleaner future. Technologically speaking, Greaves Electric Mobility is now amongst the first OEMs in India to fully transition to the 100% LFP battery technology across its EV portfolio, thereby enhancing safety, thermal stability, and life cycle value. We continue to invest in IoT-enabled scooters and battery swapping solutions, with over 850 plus vehicles deployed in Delhi NCR under our fleet partnership programs. A key highlight of the quarter was our All India Supplier Vision Summit 2025, which brought together key partners across the value chain to further align on quality, innovation, and supply chain excellence, which is so critical to our future, and thereby ensuring our ecosystem is future-ready for the next phase of EV adoption. Looking ahead, our focus will remain on profitable and sustainable growth. We are expanding our retail presence in North and West India, while continuing to strengthen our presence in South and East regions. Internationally, we have already established a footprint in Nepal and are evaluating opportunities for exporting our products to countries such as Sri Lanka for EV two-wheelers and regions in Africa for three-wheelers. In summary, H126 reflects steady progress for Greaves Electric Mobility, combining execution, innovation, and customer focus. With our brand portfolio, localized this and technology-driven approach, we are confident of continuing to be one of the players in India's transition to clean, connected, and affordable electric mobility. That concludes my remarks. I would now hand over to Akhila for the next part of this call. Thank you.
Thank you, Vikas. Good morning, everyone, and a very warm welcome to all the participants on this call. I'm very pleased to share that GREAVESCOT has delivered a healthy and resilient performance during the second quarter and first half of FY26. This reflects the continued success of our transformation journey and the disciplined execution of our strategic initiatives. During the quarter, our consolidated revenues stood at 815 crore, increased 60% year-on-year. For the first half of FY26, consolidated revenue reached 1,561 crore, reflecting a 16% year-on-year growth, driven by broad-based growth across businesses and consistent execution across markets. Our profitability metrics improved significantly during this period. Q2 FY26 standalone revenue of 552 crores with EBITDA of 78 crore and PBT of 75 crore. The standalone revenue grew 18% year-on-year, while EBITDA increased 32% year-on-year, resulting in a 160 bips improvement in margins. For H1 FY26, our standalone revenue stood at 1,092 crores with an EBITDA of 152 crores and PBT of 151 crores, reflecting a 44% year-on-year growth in PBT and 210 bips expansion in margins, supported by strong export demand, deeper market reach, robust after-sales network, and ongoing cost optimization initiatives. Our engineering businesses continued its steady momentum, registering a year-on-year growth of 31% with revenue of 406 crore and H1 growth of 30%. This performance underscores the strength of our diversified portfolio, operational agility, and strong market positioning. The automotive business recorded broad-based momentum, led by a 48% year-on-year increase. This was driven by increased in demand for our Euro 5 Plus engines from our European automotive OEM partnerships. The genset business witnessed 24% growth, and there was a continued momentum in non-automotive application of our engines. Greaves Retail reported a revenue of 146 crore, expanding across Tier 2 and 3 markets and strengthening its omni-channel model for better customer reach and profitability. Following the acquisition of an additional 10% stake in Excel Control Linkage, our shareholding in Excel has now increased to 80%. Excel reported revenues of 57 crore in Q2 and 117 crore in H1, while maintaining double-digit EBITDA margins. The combined GCL and Excel revenue stood at 608 crores, and EBITDA for Q2 stood at 91 crore with a robust margin of 15% plus. The electric mobility division delivered strong results, resulting in 199 crores of revenue in Q2 and 336 crore in H1, driven by new product launches, portfolio mix, and cost efficiency. Greaves Finance grew its AUM, including co-lending, to 380 crores. Together, these businesses continue to drive sustainable, profitable growth and strengthen our position in the evolving mobility ecosystem. Our ongoing focus on margin enhancement, cost discipline, and working capital efficiency continues to yield results. ROC remains healthy at 30% plus, reflecting prudent capital management and strong returns from operations. Our financial position remains robust, with the company continuing to be net debt positive. Our capital allocation priorities remain consistent by investing in growth businesses, maintaining a strong balance sheet, and delivering shareholder value. Looking ahead, we remain cautiously optimistic and focused on profitable growth, innovation, and execution excellence. With this, I invite Parag back to talk about the new business strategy for GREAVESCOT.
Thank you very much, Akhila, and hello everyone again. So, as you know, I had joined this company 6 months ago, and during the last investor call, many of you were curious about any refresh to our strategy, and we had promised to share more details with you this time. So I've been very energized and excited working with the team over the past few months in putting together the next phase of transformation and growth for GREAVESCOT Limited. See, over the past few years, we have been reshaping GREAVESCOT thoughtfully and deliberately, and with a long-term view of where our industry and our customers are headed. This transformation has been both disciplined and purposeful, and it is built on strengthening our capabilities and deepening our customer orientation. Today, I'm excited to introduce GREAVES.Next. This is the name of a new strategy that builds on our strengths, focuses our efforts, and positions us to deliver long-term value to our customers, partners, and shareholders. We are on a path to become a trusted, future-ready engineering company, which is built on sustainable technologies and on reliable products and customer-centric solutions. If we look back, before FY16, Greaves was largely a single product-led company, with much of the success coming from our three-wheeler auto engines business. We recognized that to stay relevant, we needed to diversify. Since then, we have broadened our portfolio, a transformation which has been achieved through a combination of organic growth and selective inorganic expansion. This today has given us a strong foundation with new capabilities, new markets, and a far more resilient business portfolio. Now we stand ready to embark on the next phase of the transformation journey. As we move forward, our focus is very clear. While our investee companies of Greaves Electric and Greaves Finance will continue to pursue their growth ambitions, the core of GREAVESCOT Limited will remain centered on building a trusted, future-ready engineering company. At the heart of this foundation lie three enduring cornerstones. You could say the DNA of GREAVESCOT, which is reliable products, sustainable technologies, and customer-centric innovation. These principles guide where we will focus and what we will build, and also how we will build it through Greaves.Next. For the GCL core businesses, we are focusing our efforts towards a few areas of interest which will drive our growth for the coming years. First, energy solutions. This represents one of the most exciting opportunities for the group. For this segment, we will deliver dependable, high-efficiency power solutions and drive meaningful growth across our end markets. Secondly, mobility area. Building on decades of expertise in powering vehicles across segments, the businesses focused in this area now represent a diversified, fuel-agnostic mobility portfolio that delivers reliable and efficient transportation choices. Third, industrial solutions. For this area, we focus on specialized industrial applications that demand consistent performance, durability, and precision engineering. This combines our domain expertise with innovation and allows us to deliver enduring value to our customers. We believe these focus segments will form the foundation of GREAVESCOT's next phase of growth, providing balance and resilience across our portfolio. So how is the roadmap to FY30 built? We have three strategic dimensions, each reinforcing the other and defining how we will grow. The first dimension is accelerating our core. As you have seen over the last few quarters, we have a very solid core business. This dimension is about deepening and growing our existing businesses, where we already have a strong market presence and we enjoy customer trust and have proven products. For example, in energy, we are strengthening our aftermarket business, expanding our service network, and building a stronger service capability which will help improve uptime for customers. Similarly, in the mobility area, we are working very closely with OEMs to enhance quality, reliability, and delivery performance. So that's what we call accelerating our core. The second dimension is building new muscle onto this core. This is about developing the next layer of capabilities. These are new products, new technologies, and opening new market opportunities, which will add differentiated strengths and unlock fresh revenue streams for GREAVESCOT. Citing another example from the mobility area, we aim to develop a contract manufacturing business that leverages our manufacturing excellence and which helps us serve OEMs in a better way. In the industrial solutions area, another example, we are expanding into adjacent categories where our design and production strengths can be applied to new customer needs. Together, these first two dimensions of accelerating the core and building new muscle will form the engine of the organic growth for GREAVESCOT. We expect these two dimensions to deliver a sustained revenue growth of around 16 to 20% CAGR over the next 4 to 5 years. Let me now come to the third dimension, which is expanding into new horizons. This dimension complements the first two through selective and strategic M&A and partnerships. This will allow us to acquire completely new revenue streams, new skills and technologies, or expand our geographic reach to enhance our core and to accelerate our overall transformation. These opportunities will be pursued selectively, where our engineering DNA and manufacturing strength give us the right to win, and where there is a clear long-term value potential. By FY30, we expect this three-dimensional strategy to make GREAVESCOT a company with, one, a larger, more balanced portfolio led by energy solutions as the key growth engine, create sharper focus on technology, quality, and sustainability across every product line, and have a broader global footprint, which is driven by exports and also by partnerships. This growth will be anchored in disciplined capital allocation as we have demonstrated. We will continue investments in innovation and a strong customer orientation. Across all of these dimensions, our manufacturing capability, supply chain, and engineering depth will be our competitive advantage. Let me talk about execution now, because the success of any strategy depends on the execution. To deliver this strategy, we are implementing a very clear operating system for execution, with each business having defined objectives, clear milestones, and sharp accountability. We are ensuring a robust governance mechanism aided by digital tools and a review cadence to make sure that every initiative translates into measurable outcomes. For this, we have identified key metrics to track our progress against the strategic plan. Once these are fully embedded in our internal systems, we intend to share updates on these metrics periodically, also with this forum as we move forward. So in summary, Greaves Cotton today stands at an important point in its evolution. We have diversified our base, we have sharpened our focus, and built strong platforms for future growth. GREAVES.next represents this next leap in this transformation journey. For us, the direction is clear, the priorities are very well defined, and the whole organization has been aligned to execute. Through Greaves.next, we will not just evolve our portfolio, we will reshape how we think, operate, and create value for our customers. We are very excited to embark on this next phase and look forward to delivering on the promise of Greaves.next. This concludes my narration of the new business strategy, and we have also completed the business update. So now I'd like to hand over to the moderator to begin the Q&A session.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Krisha Kansara with Molecule Ventures. Please go ahead.
Hi, sir. Thank you for giving me this opportunity, and congratulations on a very good set of numbers. My first question is on Excel control linkage. So what we are observing from the last few quarters is that the growth has slowed down a bit, and margins have also been impacted, especially in this quarter if we see. And you just mentioned that we are also, doing the capex in the segment. So my question is, what is the reason behind the degrowth and the margin compression? Is it that the capacity was operating at full utilization and we were not able to, cater to the orders, or was there a genuine slowdown in the order book and demand from the M&HCV segment? This is my first question. Thank you.
Okay. No, thanks for your question, Krisha. Well spotted. And like I explained in my last call, the core business of Excel, which is with the heavy commercial vehicles OEMs in India, is actually going quite well. It is strong and has grown year on year compared to last year. Where we have seen headwinds is with our export business. We had a very heavy dependence on one particular geography in the past years. And when that geography slowed down, it has had an overall impact on the export. And that also explains the margin erosion slightly, because the export business was at a higher margin. So what I would say is the core business remains healthy, strong, and continues to grow. And we have started now efforts to diversify the export business. But as you know, it takes a few quarters for new, especially global business, to come on stream.
Right. So let's say, what was the export contribution a year back versus where does it stand as of now?
So if you look a year and a half back, our export contribution was anywhere between 35 to 40%. And now it has reduced down to just under 20%.
Right. But we are focusing on increasing this contribution going forward, right?
Indeed. We are focusing on not just increasing, but also diversifying it into different geographies, and we have already started those discussions, which some are at an advanced stage.
Sure. Okay. That is helpful. Sir, my second question is on the engineering division. So our genset segment grew by close to 25% in this quarter, and even if we look at the last quarter, it grew by 30%. So H1FY26 has been a very good period for our engines division. So two questions with respect to this. One, what is the breakup between volume and price growth with respect to genset division? And two, what exactly is driving this growth? I understand that we supply majority to residential, commercial, and industrial sectors. But even within those sectors, what is driving this kind of growth? Or is it the case that the entire growth is coming from exports?
No, it's not just exports. We have had some interesting export orders, but our main growth in the genset business has come from our domestic markets. and a good question about where it is coming from. So we have expanded our reach when it comes to our genset business, and we have done that to selectively and very in a robust way increasing our distribution network. It's also that we are focused very clearly on a few segments where we see a strong fit between our product and the needs of the customers. And finally, we are starting to improve our aftermarket activities and service, so that overall first drives revenue, but secondly also builds customer confidence. And that is why we are also excited about how the genset business will continue to develop in the future.
Right, but what was the volume growth if we look at H1 for genset?
Our volumes and revenues have been growing steadily, and we are selling across a number of sectors. So actually, it would not make sense to talk about them separately in this case.
Okay. Sure. Sir, one question on the retail segment. The quarterly run rate has not grown very substantially, in the last few quarters. So what is the reason for that? And if you could give us the breakup of the aftermarket sales as to how much comes from auto engine spares, how much comes from the genset and the EV auto spares. Because my question is coming from the viewpoint that the original product segment is growing very well, but then it is not getting reflected in the subsequent aftermarket sales. So, of course, you mentioned that the diesel three-wheeler spares has seen some kind of slowdown, but if you can throw some more light on this retail segment slowdown.
Yes, I will answer that question, and there are two dimensions to that answer, partly also related to our new strategy. But let me just give you an explanation of what has been happening in the business for the last few quarters. So our main business within the retail segment is to do with the auto aftermarket spares and service. And that is a very solid, healthy business, high margin, which all of you have recognized. But that business overall volume has been in a steady decline because, as we know, the park of the three-wheeler vehicles straight after COVID declined sharply. Good news is that it is now stabilized, and actually we are tracking that the park is slowly increasing. The impact on the aftermarket business comes a couple of years after when we sell the engines. So we expect to see that the strong engine sales we have had in the last few quarters will start to translate into aftermarket business in subsequent quarters. So the core business of retail will remain steady and strong and will continue to grow. Over the last years, and this is also related partly to our new strategy, we had tried to diversify into a number of new revenue streams. And those were, you could say, strategic initiatives that we had started, and those have not performed as well and been as strong for us as expected. So within this new strategy, and very much in line with the dimension of accelerating the core and building new muscle onto the core, we have looked very sharply at some of those new initiatives, the ones which connect very well with our customer segment and our dealer channel and related to our current strength, we have kept and we will continue to do, while some others where we do not have a very strong right to win, we have decided to discontinue. And in the short term, of course, it will have some revenue headwinds, but we believe it is the right decision because it allows us to focus on the core business.
Sure. So with all these initiatives in place, can we assume that the aftermarket segment will, grow at a CAGR of 10-15% in next few years?
It will. So the aftermarket segment depends largely on how the overall diesel engine park is growing. We expect it to be just under double digits, so it will not be beyond 8-9%.
Sure. Understood. Just one last question, and then I can join back the queue. So we are seeing a long-term debt of 140 crores in this quarter's balance sheet. And last quarter on the Concall, you mentioned that for the EV business, we took 60 crores of debt. So from 60 crore to 142 crore in this quarter, in which segment have we taken this debt, one, and what is the rationale behind this debt?
Akhila will answer this.
Thanks, Krisha. No, I'll take this one. We have, as you see, done a good growth in our Greaves finance business. As end of September, we manage approximately 380 crores of book. Of this, approximately 120, 130 is our own book. So we have taken additional loans on our EV finance side, and this has come from fairly reputed institutions. We have also done the listing of one of our NCDs, and therefore some compliance related to that has also been disclosed in the public domain. And therefore, while we are a manufacturing entity, that is a financing arm. They take debt, but there is also a corresponding asset sitting on the balance sheet with a fairly well-managed asset liability a mix going on that.
Thank you. Ms. Kansara, please rejoin the queue for more questions. Next question comes on the line of Jyoti Singh with Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. So basically, I wanted to understand a few parameters. One is on the rare earth battery side, which we are doing with the Chara. So could you give us more clarity on it and when we will going to see the revenue and margin synergy? And on the EBITDA margin front, are we planning to maintain it at the current level, or is there a target to enhance it further? Though you have a guided on the strategy side, but if you can guide on the number side, it will give us a little bit better picture. And on the export front, what kind of diversification are we targeting? And is there a timeline to reach the 30% contribution level again? Then I will ask more questions.
Okay, let me just recap the questions. The first one was about Chara. The second was about some EBITDA projections in the new strategic plan. And the third one was around exports. And I assume you mean Excel exports.
Yes.
But let me start by answering the first one. So Chara Technologies, we are very excited by that partnership. We have been working closely with them, and we have a technological tie-up with them, wherein for one of their products, which is the most important one, L5, we have an exclusive partnership with them. The product has been developing very positively. We have started advanced trials with some key customers, and we expect that in the coming days and months, we will start to commercialize that. So that is really positive news and helps us to diversify into this very new exciting space. As regards the EBITDA projections in the new strategy, I already shared that while we will grow our top line from organic activities between 16 and 20% CAGR, we are also seeing a very stable portfolio mix development, which allows us to maintain our EBITDA levels at where we are today, which is a quite healthy level. And then finally, on the export piece, Excel is not just the only place where we are focusing on exports. We have multiple opportunities for getting international business across our product segments. In fact, within our new organization, we have created a dedicated group which is focused on developing international business. That has just started with this new strategy, so we expect to see a steady growth, slow at first, but then picking up very strongly in the subsequent quarters.
Okay. And sir, only we were also talking about on the auto parts business in the aftermarket segment. So we used to do 30% and now it is below that level. So when we are targeting to go again, expect to return to pre-COVID levels?
So the industry itself has changed significantly. COVID was a big shake-up to, overall the world and industry, but specifically to the micro shared mobility area. And since then, we have seen the park of diesel vehicles decline significantly. So I don't think we are going to be in exactly the same situation as before COVID as the industry. What we see is something as the aftermarket demand was slowly declining. That has stabilized now, and it will start to increase. And we have a very strong right to win. We have a very strong network and brand recognition there. So we will be able to capitalize on this resurgence of demand that we see.
Okay, thank you, sir. And also, sir, any update on the Greaves Electric IPO side?
Vikas, would you like to chip in for that?
Yeah, sure, I could do that. So, good morning. Yes, we, as you are aware, we have filed our DRHP and we are in active conversations. The DRHP does prohibit us in terms of making any forward-looking statements. However, we are in active conversations to try and get the IPO underway fairly soon. I'm afraid that's the best I can share at this point in time.
No issue, sir. Thank you so much. I will communicate.
Thank you.
Thank you. Next question comes from the line of Sonal Minhas with Prescient Capital Investment Advisors LLP. Please go ahead.
Hi, sir. This is Sonal Minhas. I wanted to just understand the Greaves next strategy that I think you indicated. As a part of this, so should we assume that the electric business and the finance business are not core business, and there will be more focus on profitability of these businesses, and there will be more financial prudence in terms of whether this business actually is a viable business to hold retained in the entity?
No. I don't think that is the right conclusion. What we have, and I hope you have had a chance to download the strategy deck that we have uploaded before this meeting. It clearly shows we have a core business and we have investee businesses. And the difference is the core business is mainly a B2B business based on engineering. The investee business are important for us. They are more consumer-focused businesses. So they will be managed with a slightly different way. That I think I want to clarify.
Okay. A follow-up question on this one, sir. What is the path to profitability of that particular business, if I may ask directionally, because a couple of there are now listed peers and their numbers are fairly known to public. They have not hit profitability even at, let's say, 2 to 3x of the current scale that you are operating at. Are there some ballparks we have or you want to share about that particular business?
Well, I'm going to ask Vikas to jump in because it is his area of responsibility, but I think he already in his previous answer gave you some indication. But Vikas, over to you.
Sure, Parag. Thanks for that. So once again, I'm afraid I'm constrained by the DRHP to share any forward-looking forecasts. However, what I would like to say is that this is an ultra-high growth, future-facing industry. And these such industries call for a fairly heavy level of investment in the initial years, which pay back in the subsequent years. I think telecom is a case in point, as it was 20 years ago. There are a lot of initiatives that are underway, which would ensure that there is a clear path to profitability. Once again, I'm not in a position to state how much and when. However, we are extremely confident and buoyant about this category, and which is the reason why we continue to invest behind it. I hope that addresses your question. Thank you.
That does. Thanks a lot. Can I just squeeze in a question, or should I fall back into queue?
Please go ahead.
Sure. Regarding the IPO, don't want to understand the timelines, but I think from broadly understanding the past IPO process from a timeline and input perspective was kind of shelved. Are we understanding correct that the new process for IPO has begun or restarted? Is that something which you can give us some broader guidance on?
So, Parag, I'll take that. So, all we can say is that the DRHP was approved on 8th of May. You have a 1-year window to effect the IPO, which is till 7th of May. I am not commenting at all in terms of what's been done in the past and what was shelved and what is underway. All I can say is that there are active conversations underway, and we should be on course for something in a reasonable amount of time. That's the best I can share at this point in time. Thank you.
Got it, sir. This was helpful. Thank you.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Next question comes from the line of Dharvi Sharma with Rita Growth Partners. Please go ahead.
Sir, my question is in relation to current technology.
Ms. Sharma, sorry for interfering. Your voice is breaking. Can you come in the range and talk?
Hello, am I audible now?
No, we cannot hear you. Your voice is breaking.
Okay, I will hear that. Thanks.
All right, thank you. We'll promote the next, that is Shashank Agarwal with Cisco. Please go ahead.
Hello. Sir, I had two questions. Sir, first, can you please elaborate on the new census facility that you are planning in Excel?
Thank you. So we have invested in a manufacturing location and facility which allows us to make the components that we need within our own products. We are seeing that the whole space is about mechanical push-pull cables, which is developing towards the mechatronics and electronic space. The first step we have taken is to develop in-house capability to supply the child parts for ourselves, and that will open up new areas. One very exciting space within that is the marine segment, where we see there will be opportunities for such mechatronic components.
So you're not selling it to other customers, it is only for in-house use?
As we start, we first use it for captive consumption. So we are not ruling out, but our first priority is to make sure our products for the marine industry have the high level of components that we need.
Okay. And so the second question, so can you please highlight the Nexus and Magnus sales individually over the past 2-3 months?
Vikas, would you like to take that?
So once again, I'm not in a position to share details. However, I can tell you that both the products are performing extremely well. Magnus is the mainstay of the portfolio. However, Nexus is the flagship and is coming through extremely well. I did mention in my opening address that we won it's the product which is scaled Shiptila pass. That's the Nexus at 13,200 feet, which is the highest pass in the country, scaled as yet by an EV two-wheeler, and that itself shows you the capability and therefore possibilities with this particular product. We are extremely confident in terms of building a nice, diverse, and impactful portfolio for our customers going forward on the strength of both these products.
So one last question. Sir, have you commercialized your MCUs?
I'm sorry, who's that question for?
The motor controller units that you are planning in the Greaves engineering segment. So have you commercialized those products?
Okay. Right. So you were talking about the e-powertrain components, including the MCUs that we have been developing. So the motor controller units are connected to the motors. So for different applications, we have for L2 applications, where Greaves Electric is our main anchor customer going forward. For the L5 and L3, we have other technological partnerships. I already mentioned Chara, and we are commercializing the motor plus the controller jointly over the next few years with our existing customers. But over the last few months, we have been actually selling L3 motors, which includes motors and controllers.
Okay. Thank you for your reply, sir.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Next question comes from the line of Sahil Jain with 7 Island PMS. Please go ahead.
Hello, am I audible?
Mr. Jain, can you speak a little louder? We cannot hear you.
Hello, am I audible now?
No.
Hello, am I audible now?
Yes, you are. Please go ahead.
Yeah, so just wanted to ask one question. So the electric mobility subsidiary that the company has, they have been making losses. So any update on that?
I'll take that, Parag. So I did share that, I think this question was asked by one of the previous participants a short while ago. I did mention that it's a high growth segment. I did mention that in a high growth segment, you need heavy investments in the initial part of the years, which pays back well in the future for later years. We have enough initiatives underway which will ensure that there's a clear path to profitability, and we are extremely confident about the future of this portfolio. Unfortunately, the DRHP prohibits us from sharing any specific details. I hope that addresses your question. Thank you.
Thank you. Mr. Jain, please rejoin the queue for more questions. Next question comes from the line of Karan with AG Investments. Please go ahead.
Hi. Good afternoon, everyone. I just had one question with management. In the last couple of investor presentation, management had outlined a plan of achieving around 15,000 or 16,000 crore revenue by 2030. Now, if I look at H1 FY26, you are at around 1,500 crores. If annualized, it will be around 3,122 crores. That implies management will have to achieve a CAGR of around 50% year on year to achieve that goal of 2030. So can you give some colors on how do you plan to achieve this ambitious target, given that your historical growth has not been that great?
Yes, thank you for that question. We had shared that our vision for FY30 was to have the number that you said, 15,000 crores. Today, what I did during the GREAVES.next strategy, I clearly outlined for our core businesses, which is a large part of our portfolio, that we have activities and initiatives in place to grow the top line by 16 to 20% CAGR year on year for the next few years. Also, you must have noticed that we have a healthy balance sheet, in fact, a strong balance sheet. And over the last few years, we have done selective strategic M&As. We will remain open now in this next phase of our strategy to do the strategic M&As within the dimension of expand new horizons of our new strategy. Of course, it is difficult to put an exact number on this M&A and what revenue it will bring, because it all depends upon the sector and the opportunity that will arise. But we believe that the balance sheet that we have, the ability that we have demonstrated of integrating acquisitions in the last few years will stand us in a good stead. So the CAGR of the core businesses added to the M&A strategically that we will do, plus the growth of the investing companies should take us towards our stated ambition.
Okay. So we are saying we'll be on the same target and we are not changing the target. We'll achieve that 48% CAGR.
We have stated a CAGR of 16 to 20% for our organic growth of the core businesses. And that, like I also said during my narration, we are very, very specific about the initiatives and the metrics that we will help us to keep track. And periodically, we will share it with this group so you can see how we are developing towards that.
Okay, fair, sir. Thank you.
Thank you. Next question comes to the line of Saket Kapoor with Kapoor & Company. Please go ahead.
Namaskar, sir. Hope I'm audible.
Yes, you are. Please go ahead.
Yeah, thank you. So when we look at the employee cost as a percentage of sales, along with the strategy which you have outlined, how should this number behave going ahead? And also the buoyancy in the core business which we have observed for H1, the factors that have attributed to the same, is there a likelihood that the same buoyancy in terms of the increase in revenue and profitability is expected for H2 going ahead?
Thank you for your question. Like I said during my first talk, that the macro conditions for the core businesses remain quite healthy. And so we remain excited about not just the coming quarters, but the coming year as well. And that has formed the basis of our strategy. And that's why we are aiming for this ambitious growth momentum. Now, as regards the employee cost, for me, employee cost is one of the investments that we have to do. Alongside, we have to make investments in new products. Alongside, we have to make investments in upgrading our systems, both in manufacturing and in across the company. So we are planning to invest because we believe that will help us to drive this growth. And initially, we'll see the investments front-loaded, but they will start to deliver revenue pretty soon.
Right, sir. And if I may just chip in a small part, sir, once we are through with the issuance, and all the best to the team, post the tendering or post the process, how will the structure, if you could give some color, whether it will remain a wholly owned subsidiary or the numbers will be reported below the line? Because currently our the incremental whatever profitability we have generated is getting diluted when we are consolidating our business with electric mobility segment. So is this understanding correct that once we go through the process, the reporting also changes considerably, or we will remain to report the numbers in this similar manner?
Yeah, thanks for that question. If you have gone through the DRHP filing, we are planning to do a primary raise of 1,000 crores and also a small portion of OFS. Depending on the final outcome of the IPO and how the process moves, we will have a far more definitive answer. But yes, that is the thinking, strategic thinking, that post the IPO, we will be below 51%, but we will continue to remain significant large shareholders in the company.
Right, sir. Right, madam. Thank you to the team and all the best. Hope to hear the news early. Thank you.
Thank you very much.
Thank you. Next question comes from the line of Nishit Shah with Ambika FinCap Consulting Private Limited. Please go ahead.
Yeah, hi team. This is Dhruv here. Congratulations on a good set of numbers. I just have one question on your Vision 2030. Parag, you mentioned on the revenue, but can you give us some idea on the margins and on ROCEs? How is the direction going to be?
So, no, thank you. And I'm glad that you are excited by our new Greaves.net strategy. So I think I answered this question or mentioned this, that we will grow the top line 16 to 20% CAGR, but we have a mix of businesses in segments which are very buoyant and attractive, which allows us to believe that our margins will remain broadly in the same level.
Okay.
The healthy levels that we have seen in the last few quarters.
Agreed. Okay, great. Thank you.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Next question comes from the line of Aram Gandhi with Gandhi Family Office. Please go ahead.
Hello, sir. Am I audible? Hello.
Yes, please go ahead.
Yeah, thank you for giving me this opportunity. My question is with respect to the IPO of our electric vehicle division. It has been 6 months since we received the SEBI approval for our IPO. What is the management's thought on this? Are we seeing any substantial demand for this fundraising? I am asking this question because if we look at the segmental data, our engineering business is doing extremely well in terms of growth as well as margins. Our consolidated EBIT margin is 17%. If we exclude the EV business, this is a very good margin profile for a capital goods company, especially when we are seeing growth in each and every subsegment, including auto engines, gensets, and Excel. This quarter also, EV reported 50 crores loss, while the other segments reported more than 100 crores of EBIT. So I wanted to ask the management that what exactly are we thinking with respect to the EV division? As investors, we are nothing but hopeful of the revival of the EV business, but given our current market share of 4%, practically it seems tough for us to compete with players like Ola, Bajaj, Ather. Are we planning to shut down this division anytime soon? I would like the management to comment on this, please.
Sure, I'll take that, Parag. Look, Mr. Gandhi, you got a lot of data points in there. I would just like to say we've kind of covered this out previously. The path to the IPO is under active conversation, and we are hopeful of a decision being taken sometime reasonably soon. Unfortunately, I'm unable to share any more details on this at this point in time. As regards the future of the EV business and the viability of the EV business, like I mentioned before, clean mobility solutions is the future. This is very clearly a high-growth industry, and our presence over here, while it may seem small, on a national basis, and while there has been a reasonable growth in market share versus last year, I would like to just repeat that we have a very high market share in states like Tamil Nadu. I did cover that out in the beginning with a 12% share, which is a very big EV market. We have 14% share in Bihar, and we have a 6% share in Orissa. So these are not small numbers. As we speak, there are also a lot of new technological interventions underway, which will continue to ensure that our products receive excellent reviews and experience from our customers, and should be very well accepted in the path going forward. So therefore, there is absolutely no plan to shut down the EV business for any reason whatsoever. I'm afraid that's the best I can share at this point in time. Hope this addresses your questions. Thank you.
Thank you, sir. Got covered. Okay.
Thank you. Next question comes from the line of Krisha Kansara with Molecule Ventures. Please go ahead.
Hello. Am I audible?
Yes, please go ahead.
Yeah. So I just have one follow-up question on Excel. So you mentioned that the capex will now come online. So what is the commissioning timeline for that capex, and when can we expect it to reach a good 70-80% utilization level?
So the capex I talked about was, and I think answered it in one of the questions. One of the capex that we did was for that manufacturing facility and testing facility for electronic components, which help to enhance our products going into the marine segment. So that is online, on stream, and as we speak, we start to supply to our internal manufacturing unit, which then increases the business in the marine segment. So that is already happening. The other area we invested in was enhancing our capability in the rubber components. Again, these rubber components are needed for us within our core products of push-pull cables, and that has also gone on stream, and there the volumes are already up and running. We have modernized, I would say, the rubber facility to ensure we maintain the high quality of our products.
Right. And how much have we spent for these two capexes?
Can you repeat the question, please, Krisha?
So the two capex plans that you mentioned for Excel, how much have we spent there?
So over the last 12-18 months, our capex would be in the region of around 50+ crores across various projects, including automation, some of these improvement projects, and stuff that Parag was talking about.
Okay. Thank you.
Thank you. Next question comes from the line of Kapil Agarwal with Daksh and Associate. Please go ahead.
Yeah. So my question is regarding this, what kind of market share this quarter we are having in our genset business, and in Greaves.next, what is our ultimate target? We can say by 2020, where we see this business.
Can you please repeat the second part of your question? I got the first part about market share, and I'll answer that. But could you please repeat
the second part is like, as per Greaves.next, what is our target by 2030? Where we see this, we can say, market share from this business actually.
Right. So our market share today, which has grown steadily over the last few quarters, is around 4%, and we keep tracking it very closely. I already said that energy solutions will be a dominant part of our overall product portfolio in this GREAVES.next strategy, and that's why we are focused and invested in that. But I don't want to state clear market share targets because it's competition-sensitive information. You'll appreciate.
Okay, thank you. And the second question is for electric two-wheeler segment. So our quarter-on-quarter top-line growth is approximately 50%, and in result also we can say our loss is also increased by 25%. So what is the reason when we are growing with 50% top-line, so why these losses are being increased?
So I think what you would need to see over here are the ratios and not the absolute amounts. So from a ratio point of view, gross margin and also the loss, we have an improvement in performance. We did have a slight slowdown in the month of July, primarily because of some challenges in terms of sourcing the motors. You would remember there were issues on the rare earth free magnets. But that was quickly recovered, and we are back on track in terms of volume, top line, and margin growth. So we don't see that as a cause for concern anymore.
Okay. And another thing is that on consolidated basis, quarter on quarter, our net worth is reduced by approximately 100 crore. So why it's like that?
Sorry, which legal entity are you referring to?
On consolidated basis.
Okay, thank you for your question. Akhila, would you like to take that?
Yeah, this is primarily due to the absorption of losses from the Greaves Electric Mobility Division on a standalone basis, as you are aware.
On console basis, ma'am, we can say in quarter on quarter we are positive only. So why on console basis net worth is being reduced by more than 100 crore? This is the question. I understand that on Greaves Electric we are negative, but on console basis we are positive. In quarter one, our net worth was somewhere around 1,600 crore, and in this quarter it is 1,500 crore. So approximately more than 100 crore is reduced.
Mr. Agarwal, are you done with the question?
Sorry?
Mr. Agarwal, are you done with the question?
I'm not getting what you say.
No.
No, just give us a minute.
Sure, please take your time.
So let me come back to you with the answer on that.
Okay, sure.
Mr. Agarwal, are you done with the question?
No.
Thank you. Ladies and gentlemen, as there are no further questions, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you very much. So once again, thanks for joining this call and for all your questions that were very engaging. And I'm also happy to say that I was really happy to see the response to our new strategy of Greaves.next. Like I said earlier, the direction for us now is clear in this next phase. We have defined our priorities, and the whole organization is aligned and excited to execute on these strategies. So we look forward to delivering on the promise of Greaves.next and look forward to seeing all of you during our next investor call. Thank you very much.
Thank you. On behalf of GREAVESCOT Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.